dispose the investment, that's a cash inflow from investing. Next one, acquisition or disposal of PP&E and intangibles. So make an investment, cash outflow. Dispose it, cash inflow. Now for investments in PP&E, draw arrows and write includes any gain or loss on sale. Now for further understanding, I've put in journal entries here. So let's say we are acquiring PP&E. The debit is PP&E, the credit is highlight cash and write outflow. Now when you dispose of PP&E, the debit highlight cash and write inflow. And then you close off the accumulated depreciation account, PP&E becomes credit, and look at that, the gain on sale of PP&E. So that is again cash coming in. So when there's a gain on sale, there's excess cash coming in, goes into investing activities. When you have a loss on sale, there's less cash coming in, which again goes into investing activities. So investing activities include any gain or loss on sale of investments or PP&E. Highlight financing activities. So these are activities which include issuing debt or equity or retiring debt or equity. Good examples include highlight bonds, highlight issuance or reacquisition of stock, and highlight dividends paid. So when you receive dividends, that was operating activities. But now when you're paying out dividends to your stockholders, that's financing. Looking at the journal entries I've got here. So when you're raising equity or debt, it's highlight cash and write inflow. When you reacquire treasury stock or retire debt, on the credit, highlight cash and write outflow. Now on the second half of this page, you've got a pro forma statement of cash flows. So the first one, you've got cash flows from operating activities. And after you list down all the activities, you get highlight net cash provided or used by operating activities. Then number two, you got cash flows from investing activities. After you list down all the sources and uses of cash, you get highlight net cash provided or used by investing activities. Then you have cash flow from financing activities. You again list down all the sources and uses of cash from financing activities, and you get highlight net cash provided or used by financing activities. When you sum up all these three numbers, you get highlight net increase or decrease in cash. To that, you highlight add beginning cash balance. And this gives you your highlight ending cash balance. And this number is the same number as you have as cash and cash equivalents on balance sheet. So the ending cash balance number on the statement of cash flows reconciles with the cash and cash equivalents number that you have on your balance sheet. Now the statement of cash flows out here, this looks so much like a summary of your cash account where you identify all the sources of cash and uses of cash. And that is called the direct method. So you're talking about how much cash came in from sales, how much cash went out to vendors for selling and G&A expenses, for interest paid, taxes paid, what was interest received, dividend received. You're looking at investing activities. How much loans did you give out, invest in others? Did you buy stocks and bonds of others? Did you invest in yourself? Did you borrow money, finance your company? Did you issue bonds, raise capital, or did you retire bonds, buy back treasury stock? Did you pay dividends? So basically, the summary of all your cash account, how cash came in and went out. That is called the direct method. Now, you're required to use the direct method for investing and financing activities. So these activities always need to look like a summary of your cash account. But for operating activities, you've got two options. First option, present it like this. This looks like a summary of cash account. Second option, use the indirect method only for operating activities. Now, in the indirect method, it's more like a reconciliation approach where you start with the net income number on your income statement and you calculate, you make adjustments, a few adjustments to get to the net cash provided or used by operating activities. So guys, once again, for investing and financing activities, always use direct method. For operating activities, you could use direct or indirect method. We're looking at direct or indirect method for operating activities. And this option is not there for investing or financing activities. So only direct method for investing or financing. You got an option of direct method or indirect method for the operating activity section. For the investing activities or financing activity section, it's only direct method. Highlight direct method. So here you list down all the sources and uses of cash. Now the next one, highlight indirect method, which is a reconciliation approach. Now this is allowed only for the operating activity section, where you reconcile net income with cash flow from operations. Now we'll be looking at examples of using the direct and the indirect method for operating activities. And before that, let me put on numbers that you have on the income statement on your book. So here you have sales $1,500. You got COGS 500. So this one is sales, 500 is COGS. You got selling 250. So 250 is selling. G&A is 100. Now, your depreciation expense separately for 125. Now, I told you depreciation expense, if it's for production related equipment, plant, that goes into COGS. If it's depreciation of your delivery trucks, that's selling. Depreciation of office equipment, that's G&A. But because we're looking at cash flows here, what we've done is we've taken out depreciation from all of these and put it together, 125. So this depreciation applies to G&A, to selling, and to COGS. Then you have non-operating interest expense of 75. Equity in earnings of investee, 25. Remember, equity method of accounting for investments, significant influence. Non-operating, you also have $25 gain on sale of AFS. Guys, this is a realized gain on sale of available for sale securities. If it was an unrealized gain, that would have gone into accumulated OCI, the A of PACE. Now this one is a realized gain, comes to the income statement. Then you got taxes, 150. This gives us net income of $350. So guys, this is something like the income statement that you have on your book. Now what we'll do is we'll assign some bullet numbers here so that it gets easy when we're using the journal entries for our direct method. So what I would say is sales, this is number 1. I would say COGS is number 2. I would say selling number 3, G&A number 4, depreciation number 5, interest number 6, equity in earnings I'll call it 7, income tax expense I'll call it 8, and available for sale securities gain, that'll be number 9. Now you also have selected balance sheet account changes during the year. So accounts receivable, it says, has increased by $200. Inventory increased by 75. Accounts payable, that increased by 50. Allowance for uncollectibles increased by 50. Accumulated depreciation increased by 125. Bond discount decreased by 15. Investment under equity method increased by 25. Deferred tax liability, that increased by 25. Taxes payable liability increased by 100. So let's get to the book, put the numberings there that I have my green pen here, and we'll come back and I'll solve it for the direct method first.